Ladies and gentlemen, there is signs and bad omens in the credit markets that we haven't seen since 2008. They're trying to tell you that everything is okay. The stock market is going up to all-time highs. Meanwhile, the real economy, the real average American, has never been worse off. On top of this, we have got the BLS reporting that they will not release the October's job data, as we got other alternative data that says this will be the worst October for the jobs market since 2003. House prices are now finally starting to fall across the US, and we also got more reports from the big retailers like Home Depot that shows us that the US consumer is absolutely struggling. So everyone, this is going to be a very in-depth, comprehensive update of all the news that has happened this week with the credit markets, with the housing market, the banks and the retailers, to show you what's really happening in the economy and the financial markets. Because people, the signs are simply too big to ignore now. So you need to know how to protect yourself, your wealth and your family for the crisis that is coming. So everyone, you know what time it is. Let's get straight into the news, the facts and the data. Well, okay, first things first, we got a lot to cover, like I said in this video, but we're going to start with this story. Financial stocks send warning and threaten to tumble below support. So what this simply means is investors for the banks and for these financial institutions, they're getting very worried. But why are they worried? Well, let's keep reading. Well, bank and financial stocks are on the cusp of crashing through key support levels, sending a warning sign to the rest of the stock market. If bank stocks fall much more or at all over the next week or two, it's going to raise a significant warning flag on this all-important group. Weakness in the sector, driven by a combination of credit problems and traders trimming bets on interest rate cuts from the Federal Reserve, threatens to take out one of the pillars of the markets that they hoped would advance through the end of the year. The KBW Bank Index has fallen 4.5% over the last 5 trading sessions, badly underperforming the S&P 500 index 2.9% drop over the same period, despite Tuesday's 1.1% bounce. So this is why I always try to warn you everyone, just because the stock market is up, it's really only because of the top magnificent 7 stocks that they call the Mag 7. And we see stocks like Nvidia, they're selling all these chips to all these AI companies. So they're kind of like the shovel seller during the gold rush. A lot of people trying to find the gold, they went bust, but it was the people that were selling the shovels that really made all the money. But like I keep talking about, 80% of the stocks on the S&P 500 are actually in the red. The decline in financial stocks showed there are quite a few cracks starting to show up in the bullish argument for the stock market, given that market expectations were high for the sector when investors assumed interest rate cuts were imminent. Well, what have we seen now? We've seen inflation surge, and this is leading the Federal Reserve to be in a very tough position, because we're starting to see the labor market tank, but inflation is still very high. And during all the other financial crises that the Federal Reserve has faced recently, like in the dot-com in 2008, well, they could simply drop interest rates and print all this money. But if they do that this time, they risk creating hyperinflation, or at least much higher than normal inflation. Further evidence of credit conditions deteriorating further led to additional volatility in the market. It's starting to look like some of these one-off issues facing financial companies might not be as idiosyncratic as many of the experts have been telling us. So exactly why are they deteriorating right now? Well, let's keep reading. Well, shares of some of the biggest US credit card lenders extended losses on Tuesday after Capital One Financial Corp reported a steep increase in write-offs, the latest warning that consumers are having trouble keeping up with their loan repayments. Meanwhile, Blue Owl Capital Inc. shares plunged 5.8% on Monday to their lowest level since December 2023, after the alternative asset manager restricted investors from redeeming capital from one of their private credit funds. So this is very worrying everyone, when we get these hedge funds start to restrict investors from taking out their money. But this is just one of the 5 warning signs that I want to go over in today's video. Because like I was saying people, we just saw something happen in the credit markets that hasn't happened since 2008. Look at this everyone, this is very alarming. So credit default swaps spike, and some AI firms now are riskier than the banks were before the 2008 crash. Now, for those of you that don't know what credit default swaps are, this is pretty much just buying insurance in case these loans go bad. Just like what happened in 2008 with the subprime mortgage crisis, what actually happened in 2008 is the insurer went bust. So what this is telling us is that these investors that are buying these loans are starting to get a bit worried that these AI companies, if they don't deliver, will not be able to pay these loans back. So it says here, credit default swaps on major AI companies are spiking, signaling rising investor concern. Oracle and other tech giants are borrowing billions to fund AI infrastructure, and the cost to insure their debt has more than doubled in just a few months. That is absolutely insane, everyone. Doubled in just a few months. A rare surge not seen since early 2023 when we saw all the bank failures. Because Oracle is planning to raise $38 billion to build AI and cloud data centers. Analysts warned that the company's adjusted net debt could hit $290 billion by 2028. That is absolutely massive, everyone. These numbers show the scale of borrowing and why markets are nervous. Investors are now buying protection to hedge against potential defaults. Because people were in a massive AI arms race, a lot of these companies are spending like crazy because they want to be the first company that can get AGI, or at least the best AI that we have. But just because you're first is no guarantee that you will have the best technology, like what we saw during the dot-com boom. And what this is going to lead to, and what it is already leading to, is a lot of these companies to overspend and over leverage. It says here, AI infrastructure is expensive. Hyperscale data centers, servers, and cloud platforms require massive upfront investments, and returns take years to materialize. If revenue growth slows or costs rise, debt repayment could become challenging, and this is why credit default swaps are moving higher. Investors want protection while staying in the market. Now, the broader picture is AI is just not a technology, it's also a financial story too. US investment grade borrowing from AI focused tech firms reached $75 billion in just September and October, more than double historical averages, and structured financing off balance sheet deals and complex lending arrangements are increasingly common, and this adds another layer of risks. Because what is this all leading to? It's leading to circular financing. Nvidia will say, okay, we're going to invest in AI. Then AI says, okay, if you invest $100 billion in us, we'll go ahead and buy a bunch of your chips. And then they're investing in Oracle and so on and so forth. And if all of a sudden these companies can't deliver, we could see the whole sector and trillions of dollars be wiped out. Now it says here, CDS, that is credit default swap spreads, give a window into how market perceives this risk. Even a moderate spike signals that investors are more cautious, highlighting the fine balance between growth and financial ability in the AI sector. So people, are you starting to get the picture here? There is huge risk in these credit markets, and they're making the same mistakes that led to the 2008 crisis. But this is all happening when the economy is about to take a huge turn. So all these AI companies that are creating this AI, well, they may have no customers to sell it to if we see the layoffs continue to spike like what we just got this report on. So look at this, everyone. This has never happened before. The BLS is actually having to cancel their October jobs report because of the government shutdown. So exactly why are they not releasing this report? What is the government trying to hide? Well, it says here, household survey data from the current population survey could not be collected for October 2025, a reference period due to a lapse in appropriations, and the BLS said, noting that household data is not able to be retroactively collected. But I'll show you another report, an alternative report in a moment, to show you why they may not want to release this October data. The monthly employment situations jobs report are crucial and widely watched data releases that give the market an overview of the health of the labor market throughout the US. The Federal Reserve also leans on the jobs report for key input on its interest rate policy decisions. So make no mistake, this is one of the most important pieces of data we can have to figure out, are we in a recession or aren't we in a recession? Now, we will get a release Thursday, and that will be the first jobs report since August, and numbers which were published before the shutdown began. The August jobs report showed the unemployment rate at 4.3%, and the Federal Reserve Bank of Chicago estimates the unemployment rate inched up slightly to 4.35% in September. But look at this alternative data that we just got. Well, look at this, everyone. US layoffs surged for October to 2-decade high. This is alternative data by Challenger. US-based employers cut more than 150,000 jobs in October, marking the biggest reduction for the month in more than 20 years. Tech firms led job cuts in private sector, followed by retailers and services sector, the global outplacement company said. So what exactly was the reason for these mass layoffs? Well, cost cutting was the top reason for layoffs in October, followed by artificial intelligence, while Doge impact was the leading reason for job cuts in 2025. So everyone, it's actually not all AI like these companies are trying to say. They're simply cutting these jobs because they're trying to save money because the consumer is broke. Now, this is how bad it was, people. The layoffs in October surged 175% from a year ago to 153,000 from the start of the year to October end, and employees have announced 1,099,000 job cuts, a 65% rise from 664,000 in the same time period last year. And as I was recording this, we got this other breaking news that Verizon is going to cut 15,000 jobs as new CEO restructures. So people, unlike they're trying to tell you, the economy is not okay. This is not the golden age for America. Now, another key part of the economy is the housing market, because if house prices go up, people feel wealthier. They go ahead and take out equity of their home, which I think you guys shouldn't do. This is what many Americans and many Australians do. They take equity out of their home and they go buy a new car. They may renovate their home and go on a holiday. But we just got new data that shows more than half of homes in the US are now down over 9%. So look at this, everyone. More than half of US homes lost value over the last year, according to Zillow data. So a researcher from Zillow revealed that approximately 53% of all US homes have lost value since last year, up from 14% from a year ago. It's notable given that a share this big has not been seen since the tail end of the Great Recession around 2012. That's when we saw the worst of the home price decreases. Most homes have lost value from the peak, falling 9.7% on average, and is much larger than the 3.6% reported in the spring of 2022. Home values surged over the past 6 years, and a vast majority of homeowners still have significant equity, but what we're seeing now is a normalization, not a crash. Well, that's what we're seeing so far, people. We all saw it. Home prices went absolutely crazy after the pandemic. People overpaid. People rushed to less populated areas. Now people are moving back to where they lived before the pandemic. And we're seeing a huge house price correction. But this is only one piece of the puzzle. We also got another report from Home Depot that shows that yes, indeed, the US consumer for household goods is not doing good at all. So look at this, everyone. Main Street Bellwether Home Depot gives alarming sales update that points to a recession. And this is what I've been saying all along, people. I think we're actually in a recession now, but they're simply trying to not release the data or change the definition of a recession. So this is the third consecutive quarter that Home Depot, an overperformer in recent years, has missed profit expectations. So things are going from bad to worse. The company said it has had to raise some of its prices because of tariffs and served 1.4% fewer customers and seen a 0.4% drop in foot traffic according to its data. Our customers are homeowners, he said. They're seeing home prices now decline in more markets than rising, and we know they have job concerns. And this really reveals the state of the average US consumer. So people, I know what you're thinking, well, okay, that's a lot of economic jargon and financial jargon. What does this mean for you in simple terms, and how can you protect your wealth and your money? What this means is, everyone, we have all the signs warning us that something is very, very wrong in the credit markets and in the banking system. Banks are having to go to the Federal Reserve to get emergency cash, like we're seeing in the overnight Federal Reserve repo facility, and we're seeing investors getting very, very concerned with the overvaluations in the stock market right now. We're seeing a lot of companies scramble to get private credit, but a lot of these investors are not wanting to give out this credit because liquidity is drying up. But the only thing stopping this recession from going to things like what happened during the Great Recession in 2008 is the job market. Once we see more layoffs, once we see people not being able to spend, and we see a few companies' earnings miss, or they took on all this credit and now all of a sudden their revenue growth is not like what they thought it was, and they default on some of these loans, and then the banks take a hit from some of these loans, that's when we're going to see the real crisis hit. So there's 4 simple steps you can do to protect yourself right now. One is you don't want to make the same mistake as these banks and these investors are making by being over leveraged. So you're all high interest rate debt beside your home loan, you're going to pay that off as fast as you can. Second, you want an emergency fund or a dry powder fund. So when this recession really hits, you won't have to panic if you lose your job. And if you see assets sell for pennies on the dollar, instead of being like everyone else that has no money to invest and buy assets for pennies on the dollar, you will have money to deploy in the markets and get great discounts. Third, you need to increase your income. There's simply no other way you can do it. You need to find a way to save money and increase your income. Some people try to say, look, just cut back, or some people say, look, don't worry about cutting back, increase your income. No, you need to do both, people. Next, you want some insurance like these investors are against a financial crisis. Now, the best insurance, in my opinion, not financial advice, is gold. Every single crisis, gold tends to outperform. Everybody runs to a flight of safety. But it's not only protection against a financial crisis, it's also protection in case the Federal Reserve comes out there and bails everybody out and prints all this money and the dollar loses purchasing power. Well, it'll protect you against the dollar purchasing power being reduced as well. So everyone, if you do those 4 simple steps, you'll be more than okay. You'll actually be prospering during this crisis. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.